despite the fact that we did see the failure of First Republic, the street is still betting that the Fed is going to keep going and raise rates. The latest Fed funds future showing a 90% chance of a 25 basis point hike this week. But is that the right move? We want to bring in Kevin Flanagan, WisdomTree head of fixed income strategy. Kevin, it's good to see you here. So let's start with the Fed implications. Another bank failure here this year. Do you think it's going to have any impact on what the Fed does on Wednesday?
No, I really don't. I think what the Fed's looking at, if you just go back to the minutes for the March meeting, you can kind of, dive in a little bit into the inner thinking of the voting members. Is they're looking for any kind of strains or stresses in the funding markets. And quite the opposite. Actually, the funding markets are beginning to show some signs of alleviation of the pressures that we saw in March following Silicon Valley Bank and Signature Bank. So as long as I think the Fed sees the plumbing, for lack of a better way of putting it, is in order, that they'll give us that one more quarter point rate hike.
Yeah, Kevin, so it sounds like, is this essentially already priced into the market? And then do you think, well, likely it sounds like maybe get a pause after this meeting?
Yeah, it's going to be interesting. We've been finding out that when the Fed meets, the policy statement tends to elicit a market reaction, and then Powell speaks and we get a whole nother market reaction. So the Fed's communication skills are really going to come under the microscope, I think, as we move forward, because it's no longer this thought process. Are they going to, raise rates by 25, 50 or 75? It's what are they going to do next? Are they going to go on hold? When could they consider cutting rates, which we don't think is going to be the case for a while anyway. So it's going to be interesting to see how the Fed communicates this going forward. I think they want to keep their options open and have some flexibility. I don't think they want to pigeonhole themselves with the policy statement on Wednesday.
Kevin, in order for the Fed to potentially cut rates later this year, what needs to happen? What is that likely catalyst to get them to do so?
Well, I mean, for them, it's inflation, right? They keep telling us there's more work to do. Now, that doesn't necessarily mean more rate cuts, but it does mean keeping policy on hold, 5 to 5.25% Fed funds for the foreseeable future. So I think we need to see definitive signs inflation is getting closer to their threshold of 2%, not necessarily getting to 2%, but more than what we've seen now. I mean, their preferred measure of core inflation last week was still 4.5%, 4.6%, somewhere around there. So there's a lot more wood to chop for the Fed. So that and some softening in the labor markets, I think, gets us to the Fed talking about rate cuts. I don't know if you remember that with rate hikes. That was another one of Powell's famous lines.
I certainly do. Quite a few meetings ago. Kevin, let's talk about what the bond market is signaling, because for quite some time now, the bond market has been signaling a recession, and it doesn't seem like we have seen that yet. Do you agree? And how likely do you see a recession here within the next 6 to 12 months?
Well, yeah, right. The classic bond market ghouls, bad news is good news. So there seems to be a decent amount of that bad news priced in at this stage of the game. So you kind of wonder how much lower can yields go in the environment that we've been seeing. I know they've popped up a little bit today, but just recently you had a 2-year Treasury yield under 4%, which is kind of strange considering you have a Fed funds rate at 5%. Moving forward. So I think as we move into the second, third, maybe for fourth quarters, should investors expect to see a 0 or a negative real GDP reading? I think that's a reasonable case scenario. We were there last year, right? We had 2 consecutive quarters of negative GDP. So it's not as if we haven't been there before. I think the question is going to become not whether we get a negative GDP report, but by how much.
So Kevin, what does all this mean then for investors? How should they be playing this pretty uncertain environment?
Well, in the bond market, right? Looking at the yield curve, it still remains incredibly inverted. You're not being paid to move out on the curve into duration. So we continue to like Treasury floating rate notes in that aspect of things, and also high yield. It's interesting, even though we were talking about recession, a quality screen high yield I think option also makes a lot of sense for that core plus, because as we said, much like the Treasury market, what you're seeing in other fixed income markets does seem to be some pricing in for the potential for a recession and even higher default rates. So you're getting a coupon at 8.5%, 9%, a lot of cushion there in the high yield market.
And Kevin, when it comes to some of those other concerns out there, of course, weakening corporate profits is something that investors are watching. You also had the debate down in D.C. over the debt limit. How are you calculating that? How are you factoring that into your assessment, into your outlook here over the next 6 months?
Yeah, I mean, on the earnings front, right? I mean, people are debating, is it going to be an economic or earnings recession or both? I would imagine with the slowdown that most of us are anticipating, you do expect to see some impact on the earnings side of the equation. But from the debt ceiling perspective, that's a whole different scenario that we're talking about now. I mean, we saw last week the Republicans come forward with a plan. Hopefully that begins negotiations within the Biden administration and we move on from there. But I think there's a lot of headline risk moving forward. And, for lack of a better way of putting it, it's going to get messy. But I do think ultimately they do come to an agreement and raise the debt ceiling or just push the can or kick that can down the road.
All right, Kevin Flanagan, always great to get your perspective. WisdomTree, head of fixed income strategy. Thanks so much for joining us here this afternoon.
Thanks.